Hello, welcome everyone to Bramasol's webinar series. I am David Fellers, the CEO of Bramasol, making a special guest appearance hosting our webinar today. We're excited to talk to you about revenue recognition, some of the intellectual property that helps with the solutions, some of the unique approaches and solutions and tips that we have run across over the years and over recent times around real-world revenue recognition projects. And for today, we have a special presentation with a panel of experts to walk us through these topics. Let me run through some of our normal housekeeping basics. We are recording the session, and we will make it available. In fact, for those of you who are here and registered, you'll have early access to this recording. You may ask questions throughout. You have a panel where you may enter questions, so feel free to do so. We'll attempt to answer any and all that we can during the call or follow up afterwards. And we do have a series of these webinars from over the years in a variety of formats in our Bramasol website. YouTube, very popular location with over 250 of these that many people are accessing, and there are other venues to find this information. So let's get started. Thanks for joining us. Well, we're going to talk about revenue recognition today. So I know a lot of you do know and have joined us before. You know a lot about Bramasol. Bottom line is revenue recognition is our passion. We've been doing it for a long time. SAP's revenue accounting and reporting tool came out in 2014, and we were working with them even before the release on the product. We were part of the early customers that helped in the ramp up and the testing phases of the product. And through its many different iterations of upgrades over the years, we've worked on more revenue recognition projects in the SAP space than any other implementer. We bring a lot of expertise around the hows, the technicals of configuration and programming, but we also have the business and accounting knowledge. I was trying to count it up. I think we've seen well over 100 different business scenarios over the years from different companies. I'm probably undercounting that too, that companies are trying to explore. Revenue recognition is a great tool, but it doesn't have everything, and we try to augment it. One of the big things we've augmented, and we'll talk a little bit about it today, is the disclosure reporting for both the IFRS 15 and ASC 606 areas, and we do that in a variety of ways. We also have some other items, and we'll touch upon that today. And you know, this is a world that's constantly evolving. Revenue recognition is an important regulatory requirement, and it can be tricky, but companies are moving forward with what we describe as digital solution economy solutions, just such as offering subscription and consumption business models, those kinds of things, and leveraging SAP's product tool suite around the quote-to-cash, such as BRIM and its components around convergent invoicing, convergent charging, all those kinds of things. They lead to a lot of complexity as well that RAR revenue accounting and other SAP offered revenue recognition solutions do address, so we're excited to talk to you about that today. Today with our panel, and I'll introduce them in a moment, we're going to touch upon these 4 different topic areas. Standalone selling price, which is of course a core concept since the initial regulation came out. And then some other ones that are a little more maybe esoteric, not always front burner, but they are important to consider and think about. So we wanted to share some insights, significant financing components, handling commissions, and then we wanted to show you some of the dashboarding, both around the disclosures as well as operational and management reporting, leveraging the revenue recognition information. I am here to facilitate today, CEO Bramasol. We have our regular host of all our webinars, John Froelich, joining us fresh off of a vacation to Europe. We have some experts from Bramasol as well, in addition to John, such as Jacek Dukowski, who's a director in Bramasol, Frank Josbacher, he's a project manager and center expertise person from Bramasol, and Vivek Thomas, a project manager and head of our intellectual property strategy and development teams. So welcome to all of you. Excited to hear from you today about a bunch of different topics. And we're gonna start with standalone selling price. And you know, we'll have a little bit of a panel and interaction, but we're gonna ask Jacek, why don't you get us started and talk about this foundational element of revenue recognition?
Sure, thank you, Dave, and good morning or good afternoon, everyone, or good evening, depending where you are in the world. So let's talk about selling price and SSP and all the about a goodie. Obviously it's a foundational element of the new guidance since we've all been dealing with since 2017-18 timeframe. And it is used to allocate the revenue in a multi-element arrangement, which is the guidance language for something where you sell multiple things in one deal. And allocate the revenue based upon a fair market value. That's an important concept. So regardless of what I will bill my customer for a particular line item, the revenue that I should allocate to that line item for my internal and external reporting should be corresponding to that item's fair market value. And then the question became, well, how do I know the fair market value of an item? And this is where we get into how there's very different approaches. One of the most basic approach is what we're calling the adjusted market assessment. I will look at my product and I look at competing products in the market and we'll say, well, my product is X dollars. Let's use a very old example of I sell a phone, a cellular phone device in the market. Well, I'm going to look at competing devices, Apple, Android, others, see what the average market is paying for them and say, well, that's probably about a fair market value for my device given its features and capabilities. Another way is I can, if my industry works on that custom, I could maybe look at my expected costs for a product plus a certain margin, which is standard to my industry. And that could be a fair market value. Some industries do that. They look at their costs for projects or products they make, and then they have a customary margin that is maybe more or less standard to the industry, and that's the SSP. And finally, if all else fails, you can do what's called a residual approach, which is if I have other items in my arrangement, which I know fair market values for, but this one line item is just unique, I don't know what to do with it, there's no way for me to assess. Well, the guidance allows you to do something called residual approach, which is sort of anything that's left over you can assign to this one. Now, what we'll talk here about is what we've seen in the market is that, an interesting market, what we've seen our customers is that most folks have really focused on doing this adjusted market assessment because they're benchmarking themselves against either others, or more importantly, they're benchmarking themselves against what their business was able to do. And this is where Bramasol has seen in our implementation and also developed some functionalities and tools which we work with our customers to add on top of the SAP's RER engine to calculate and adjust the SSP. So let's focus on this adjusted market approach. As I said, one of the things you can do is look at, well, the market is this much is what their competing products are selling for, therefore I can use this value. Well, what if you really don't have good information on that? Another way to look at this is, why don't I see what my customers were willing to pay me for my product, maybe for the last 2 quarters, last year, last X number of months, and see what of the average revenue I was getting, and maybe that is a fair market value because that's what the market will bear, right? Every one of customers will negotiate, hopefully, to one way or another. You will give special discounts, you might do that. So there's always the list price, and then there's eventually what I was able to get. All of us who have bought a car and dealt with a car dealer, I'm sure you know exactly what I'm talking about. So the adjusted market approach using your own data seems to be fairly relevant because I'm using my own data and I control that data. I know what's in it, I can look at it. So Bramasol has developed functionality which our customers are using in multiple projects where we analyze the past sales for a particular product. And then based upon those sales, we can determine what's the fair market value of that product, perhaps for the next quarter. And the word market is key here. What customers have been doing lately, so you heard me open with this is an oldie but a goodie. We've seen this evolve to be more sophisticated. We've seen customers looking at market segmentation a lot more and saying, you know, my market isn't all my customers. My market is actually 2 segments. I have enterprise customers and I have retail customers, or maybe I have enterprise, private sector, and public sector customers. And they start doing that segmentation to really optimize the way they calculate and apply SSP, which is eventually optimizing the way you will do revenue recognition. And we, again, at Bramasol have worked with our customers to develop functionality in an add-on engine, really, on top of RER, that allows you to create that market segmentation in your data and to really specify the SSP applicable for a particular transaction based upon its market segment. And that is really the latest evolvement of this SSP concept that we've been seeing in our customers. More and more granular, more and more sophisticated approach of this. And finally, that tool and what we've seen our customers ask when we build into this tool, and again, what we've seen customers using is this really detailed segmentation, this statistical analysis of data where I can identify and eliminate outliers, things that, for whatever reason, this customer paid $0 or otherwise, for whatever reason, this customer gave me MSRP because they just didn't want to negotiate. Maybe those are outliers you don't want to count in your analysis. We're also, obviously, there's a tolerance analysis, which customers are asking for, and we have accounted for, and the tool itself works with, where if your SSP that you calculate versus what your actual sales price you are able to achieve in a particular deal are close enough within a certain range, then perhaps you don't need to adjust the SSP. And that's, again, a concept within the guidance that customers are taking advantage of, again, to optimize the revenue recognition. So as you heard me say, we're seeing an evolution of this fairly foundational concept. We're seeing an evolution to go into a much more granular application, a much more sophisticated analysis, as, again, with the use of the SAP's RER product.
Jacek, this is Frank. Are there any limitations to the segmentation rules? For example, for a particular offering, might there be a different SSP related to selling to resellers versus, again, as you said, the retail customers?
The real limitations are what you make them to be, but obviously we're working with SAP data, Frank. So if I can identify this differentiation, I can segment on that. So in your case, for example, maybe I'm using the sales channel as my differentiator or an SAP SD customer group. It's important to understand, at the end of the day, I have functionality, and I need to tell that functionality to differentiate between data A and data B. And so what are we using as differentiator? So we can configure that if we're using this engine, but at the end of the day, we do need it to give the data to analyze. And so if that data doesn't exist, if I'm using the same customer group, same customer channel, it's going to be really hard to differentiate between my government customers and my public sector, and my private sector customers.
Might one want to use different tolerance ranges based on the segment?
Absolutely. Once you define a segment, then you can define SSPs and tolerance ranges by the segment.
Frank and Jacek, I'm gonna impose on you guys. This is great, but what's the so what of this? Why? Our audience listening here. Why is SSP so important? And why is having a tool that accurately measures it and does it based on a statistical approach, why is it so important, and what does it mean downstream to that?
Thanks, John. That's one of the things that I mentioned is SSP is foundational to the IFRS 15/IC 606 guidance. The whole fair market value analysis, multi-element arrangement are at the core of that guidance. And what we've seen customers, as they evolve and they get more experience using tools that align and give you compliance to the guidance, is that you can optimize these processes based upon the way you sell or your business scenarios or the markets you serve. And that allows you to optimize revenue allocation for whatever reason. And there are many reasons. For example, revenue allocation that works in one segment might not work in another segment because maybe that segment has different tax rules or different whatever rules, right? Different reporting rules for, you call it, right? We're talking countries, IFRS 15 across the globe versus maybe local GAAP. So there are many reasons why customers choose to do this. And again, ability to get to a more granular level at this analysis is advantageous. And that's what we've seen customers asking of both SAP and us as we work with the SAP's RER tool. And that in our response, we've developed functionality into this add-on engine.
That's a great answer. Thank you.
Yeah, really excellent. I know over the years, when it came to compliance, companies just wanted to get through the SSP. They just wanted to get a number in there, and now it's evolving as you've mentioned, the granularity, the looking at the different business lines of business, the different segmentation. It makes a lot of sense that companies want to evolve their way of thinking so that they can more accurately leverage take advantage of the regulation and comply in a way that makes more sense. As of course, this is a judgment-based regulation, and companies are learning how to use their judgment better and better. So it's good that we have a way to support the SSP side of that, which is of course one of the big steps in the whole process of getting that fair market value right.
Yeah, absolutely. And Dave, when you think about it, right, what happens in the market? I am selling product X, and if I'm a smart company, if I'm one of the leaders in the market, I'll know my competitive landscape. But what if I get blindsided and something enters the market or something changes, and suddenly, my product is no longer in high demand, and I'm seeing my sale price dropping and my demand for discount for my customers becoming more aggressive. If my pricing team was on top of their game, they would have caught it. But what if they didn't, right? Then this analysis allows you to catch that also, to understand that, hey, the price that the market can bear is changing here. So is my SSP, but more importantly, is my MSRP aligned to that? And what's happening? And why is that? What is the changing sort of market picture look like? So if you think of this data, again, optimization of your revenue recognition processes is the key here. Use your own data, but also you can narrowly focus on market segments and specific factors and apply to your revenue recognition process.
Excellent.
Jacek, for the expected cost plus margin approach, how much diversity or how much segmentation have we seen with customers? It's easily for me to understand that a custom offering would be one of this type, and someone in the business world would identify the margin requirements for that kind of offering or business. To have that be different by geography makes sense to me. Any further kind of segmentations that you've seen?
Yeah, this one, interesting, Frank, applies a lot to the private versus public sector. For both of us working with the government, we know that sometimes there are rules in terms of how much money a contractor can make to government, in terms of their cost versus what they are allowed to make above and beyond that cost. So we're really seeing some differentiation there in the expected cost plus margin. Again, this approach really works for industries that have identified a customary or expected margin for the type of products and offerings they do. So that's where that comes into play.
All right, excellent. John, any closing thoughts on SSP?
I think it's a great summary. And why did we approach this? Because customers came to us wanting an external tool that allowed them not only to analyze and understand SSP, but have a tool that provides external data for additional analysis. And as Jacek so well pointed out, a lot of our customers are finding this tool provides them with insights on their market segments so much better. So it's a great set of IP that we've developed, and is helpful for customers not only to understand, but to reduce the amount of time. As an automated tool, it's going to give you automation of this process as opposed to doing it manually every quarter. So,
and one thing I wanted to add, John, what we've seen customers now increasingly asking, and we have also addressed that in the tool's functionality, is this tool really started as a reporting engine, really to give you an idea what SSP should be for a particular transaction. And the customers sort of said, why don't you just take it a step further? You're showing me the data, why don't you just go and use the data? And we've done that, and we've integrated both downstream and upstream, where we integrate this data now. If a particular customer implementation calls for it, it can be integrated directly into a revenue recognition engine to be used real time in the transaction. Or in alternative, it can be integrated in upstream into the transactional system to be used as part of the pricing of a particular transaction. So let's say your customer that uses a Salesforce.com order system on top of SD, or uses SAP SD as the ordering system. The data from this analysis can be sent upstream to those tools to use it in the order creation. So then it's pervasive throughout the rest of the process. So not only did we develop this functionality, but we also have developed now integration layers, which again, customers have been asking for. And you will see as you think of your implementations in revenue recognition, these are some of the things that perhaps will come up. So how do you integrate this data across your end-to-end process?
Great point.
Excellent. Well, let's move along now. Standalone selling price certainly is the foundational cornerstone element, but there are other topics in revenue recognition that can give challenges to customers that we've worked with and have some insights on. And what I'd like to do now is go ahead and switch to our next topic, significant financing component. And Frank, I'll ask you to get us started on this one.
Sure, and this is another situation where over time our customers have become, shall I say, both more sophisticated and more nuanced, and so significant financing components have become more widespread as customers' revenue contracts become more complex. In the bad old days, when a particular offering was sold to the customer, usually the revenue recognition occurred along with the payment schemes that occurred for it. So there was no issue in terms of the so-called financing, and I'll describe what that is in a moment. However, in more recent times, more sophisticated patterns have emerged, and again, I think there's, as Jacek mentioned about the phone, the mobile phone sales. I can have a phone and a service sold together, and both of them are essentially paid for over time for a 3-year period, for example. But the hardware, the phone itself, really transfers to the customer, me, immediately, whereas the service comes over time. So that discrepancy between the transfer of the good versus when it is paid for is the source for significant financing components. So essentially, the SFC, the significant financing components, are a portion of a performance obligations price that compares the transfer of the goods against the timing of the payments. So when things are aligned, payments and revenue streams are aligned, there is no issue of significant financing components. But when they are misaligned, then there are portions of that revenue that should be assigned to either interest income or interest expense. So if indeed there is an early transfer to the customer and late receipt of payments from a vendor point of view, then that's an earned in advance scenario, and that becomes an interest income situation. The opposite, of course, would be where there are early payments, and from a revenue recognition point of view, those are reflected as deferred revenue balances over time. And so if the early payments occur and the later transfer or revenue recognition occurs, then that's a paid in advance scenario, and that would represent a significant finance expense situation. Now, this does not matter within a 12-month period, so only longer-term scenarios are relevant here in these significant financing components. Now, portions of a particular revenue contract could indeed be short-term. You may have, again, a piece of hardware that is sold, and therefore a revenue would be recognized immediately, instantaneously. But again, if the payment scheme that is associated with it goes beyond the 12 months, then again, the SFC, the significant financing component evaluation, is relevant.
Frank?
Yes, go ahead.
Frank, so let me get this straight. Customers want good deals. They want to get access to products or services, but they don't want to pay for it right away. And when you hear kind of that tagline of no interest being charged, the truth is, for the seller, for the vendor selling a product or service and not collecting that money right away, even whatever that dollar amount is, they have to build in some interest for themselves. The regulation for revenue recognition says there is an interest impact here, and you have to allocate some of that money to an interest side of things, not just the straight up deal. So What looks clean and simple to the customer, hey, I get something and I don't have to pay for it right away, looks good. For the other side of this, for disclosure reporting, you have to take into account, well, there's a multi-year time period going by perhaps on payment. That's really what this is all about, at least from the seller side.
That's correct. And if I, as the furniture seller, sell a sofa to a customer with a zero interest payment scheme involved, I do need to report my significant financing component interest income for that. So yeah, even on an individual basis, that can be relevant. But of course, usually our revenue contracts, the ones that we encounter, are complex, and oftentimes there are bundles, several performance obligations that belong together, logically speaking, and so everything needs to be pulled together on a contract basis. Even though on a performance obligation basis, this is where the SFC evaluation occurs specifically. So once one has evaluated at least the significant finance components on a performance obligation level, then the question is, are the results, the SFC components, material for reporting as interest income or as interest expense? And that is usually done on a contract-wide basis, which basically means one needs to sum up or net out all of the SFC amounts for all of the performance obligations in a contract. And if that exceeds a particular threshold that's relevant to the vendor's business, then the SFC components need to be broken out and then reported on a periodic basis as interest income or interest expense. Now, how does one evaluate the SFC components and then establish what the values really are? On the one hand, yes, we've already talked about the revenue recognition stream, as well as the payment schedule or payment stream. And essentially, it is the net present value of each of those streams that needs to be compared. So one of the benefits of having the SFC components evaluated within the RAR framework of doing revenue recognition, one has already the planned revenue patterns in RAR. And if the source of the sales orders is the SAP Sales and Distribution Module, SD, then also the planned invoices are also available in RAR. So all of the relevant data is at least present there, and RAR also offers a net present value calculation. A specific interest rate needs to be applied or designated for the evaluation, but then the two streams can come up with their respective net present values, and they then get compared, and that's the source then for the SFC amount. Okay.
That sounds good.
Now, if the sources, go ahead. Yep.
Sorry, Frank. Just as you pause there, it does sound like it starts getting more and more complex, doesn't it?
Yes. So again, if for example a contract consists of a single performance obligation, which at least in the SAP world would be a single sales order line item, so a sales document is represented by one sales order line item. One can indeed perform the SFC calculations on just that. All right. Oftentimes, the contract is made up of all the line items from a particular sales order, but it could also be made up of the line items from multiple sales orders. So again, having SAP SD as the source of those line items and therefore of the performance obligations is helpful. If the sources of RAR performance obligations are external to SAP, then it is important to have the payment schedule related to each of those coming into RAR as well. Otherwise, RER wouldn't be able to, or the RER database wouldn't have the data available for the respective calculations. Okay, but as you mentioned, the sophistication goes beyond having multiple sales orders. Sometimes there are relationships between sales order line items among sales orders. So it's really important to have all of these line items wind up as performance obligations in RER. And once they are all there, essentially the revenue accountant would be the one to know that they are indeed present in RER, then that the revenue accountant could trigger the SFC evaluations and calculations and have them then be part of the regular postings to the general ledger. Usually what happens, of course, is that the SFC components wind up being time-based linked performance obligations. So they are not as simple one-time postings. They are indeed postings over the term of the SFC scope.
Okay. One of the things I'm hearing you say is that this is a fairly sophisticated functionality that's sitting sort of on top of SAP's RER module as developed by SAP, and something that we've seen with other customers, right? What did customers have to do before if this was not available? Did it mean that even if I implemented RER, I would have to do some still back-end manual calculations to do, or manual additional adjustments on top of what RER posted? So how would compliance work with this if this was not automated?
Right, and essentially the real value of the RER data is these so-called allocated amounts, i.e. the revenue to be recognized in each of the fiscal periods. That is not the same as, again, the invoice schedule. So it is important to have the revenue to be recognized in each period available, and that would need to be extracted out of RER into whatever workbooks, worksheets the customer would be using. And they would then apply the payment schedule or the invoicing schedule against the revenue schedule and essentially apply the net present value calculations on a spreadsheet. So to have that inside RER on top of the RER database and then also posted to the general ledger along with the revenue postings from RER is a real value add, right? Because the data is essentially aligned and no separate manual GL postings are then necessary. And also it's not necessary to have the spreadsheets being refreshed all the time to establish what the postings should be.
So what I just heard you say is that one way or another, even if I were doing this manually, I would need my data in the contract POB model that obviously the guidance request, as well as RER creates by its nature, and then it's becoming useful, and I can apply whether automatically through some of these tools that you're talking about, that we developed with Bramasol, or through some sort of other process, the SFC calculation. But it becomes very difficult for me to do when I have just the order transactional data information, line items, and invoicing, without really understanding the revenue allocation, revenue recognition patterns that come downstream.
That's correct, and businesses usually know what their cash flows are. In other words, what the invoicing streams are, because those are the nominal numbers, but the revenue, the allocated amounts among the performance obligations, essentially is only available through RER. Yes.
I see. So the two work together very well. Thanks.
Yep. And so if I were to be asked, so what? This is really where the value add is, allowing SFCs, these significant financing components, interest income pieces or interest expense pieces, depending on how the two net present values are come out, is a real value add within the RER space.
And I think, Frank, thank you for that. You know, what you also have, and I think you can highlight, and we do have to jump to the next topic, but quickly is, not only does this, you know, it might be easy for somebody to do this calculation on their own one time, right? But it's just like revenue recognition. The power of these tools is the fact that nothing ever stays the same, and that things are constantly changing, whether it's a contract combination, contract modification, cancellations. You have to take that in mind as you go through this process, right?
Yes, and one of the insights that we've gained in this space is that to automate it process-wise doesn't really make sense. Again, I'll comment that it's up to the revenue accountant to trigger either the initial SFC evaluation or a subsequent SFC re-evaluations based on whatever changes might be occurring on the appropriate contracts. To do that automatically all the time would be just way too much churn and might provide results that really aren't appropriate or usable or effective for the client. Again, the materiality point, a particular threshold of significant finance component values or amounts per contract is important, and you don't really want to be posting interest income expense on small things, only the larger ones that are material for the business.
Yeah, makes sense. Let's
Awesome.
move.
Thank you.
Yeah, awesome, Frank. Thank you for that, John and Jacek. And this topic too is not just revenue accounting, figuring out financing, because you got your sales organization too that you have to collaborate with, because they're the ones wheeling and dealing on deals, either asking for maybe payments up front, down payments, or telling customers they can delay it. So that sales organization feeds into this. But with that in mind, let's keep moving. We have our next topic, and I think, Frank, I'm gonna ask you to kick us off on this one as well, and that is around handling commissions. Yeah,
so in the SFC space, we were comparing a payment stream against the revenue stream, and in the commission space, again, we have the matching principle of contract revenue and contract costs. So one of the changes in the accounting rules, along with the implementation of RAR, is that sales commissions are no longer all expensed when they are incurred. So commission costs need to be aligned with the revenue stream associated with what has been sold. So if something has sold that is going to take more than 12 months to implement or to complete the revenue recognition stream, then the commissions also need to be extended to a particular length of time, which is designated by the accountant organization in the business. So for these scenarios where I have a service that is longer than 12 months and I pay commissions, that commission need to be capitalized or posted as an intangible asset immediately, and then amortized to sales commission expense over time, 36 months, 60 months, whatever is appropriate for that offering or for that business. Okay. As it points out here in the slide, it's usually posted to cost centers as costs. Okay, and so it's helpful to have the commission amounts of the commission postings available to RAR that can either be applied as part of the selling process or from an external source coming into RAR as costs. Okay, acts a lot like invoices that are posted for revenue. In this case, these are cost postings that are, shall I say, reversed in RAR and then recognized as cost or as expense items to the general ledger over time.
This is an area that really shows one of the impacts of this regulation of really having to match the timing of your revenues and expenses. The whole point of revenue recognition is you can't just claim your revenue when you want to. You have to map it to your obligations and your commitments to your customer. but you also have to tie that to some of the cost structures that happen over time, commissions being a very obvious one, that you pay out to your salespeople, say on a 3-year contract. You can't just say, oh, well, I paid that whole amount today, I'm just going to recognize it, because if the value of the contract lasts 3 years, you have to tie it to that.
Right.
And I know there's other areas like that as well, but commissions is an important one, right? Because again, you got that sales organization and their side of things impacting the accounting.
And again, the materiality is important here. So when there are large contracts themselves with their the multitude of performance obligations that are involved in them, to have the commissions specifically assigned to those revenue contracts and essentially become reportable from RER as part of the contract life is important. But for the smaller contracts, it is more helpful to have the commissions assigned as portfolios for either offerings or for offering portfolios, essentially collections of a sub business. Okay, and to have those be brought into RAR and again amortized over their respective life terms, and then posted again along with the other revenue contracts to the general ledger is helpful. So where, again, as the slide shows, where a particular commission value can be assigned to a particular revenue contract, then using the SSP values on the respective performance obligations is a helpful way of distributing that commission cost among the member performance obligations. So that is certainly a useful tool to use. But again, for the so-called portfolio commissions, they are designated for particular, either a collection of offerings or offering types, but they can still be put into RER and reported along with all of the revenue contracts of that same type. Okay.
So as a number of things in the RER, being able to capture and report that information needs a little assistance. So we have both a tool set, both for the contract side and the portfolio side, which you do see out in the industry as well. So right. A lot of people are interested in that.
I think Dave, what's important for our customers to keep in mind is what we're doing here is we're using the SAP's revenue engine, RER, to manage also the contract acquisition cost side of the whole accounting space. And we're doing that because the RER engine is in the best position to understand both the various performance obligations within a contract, how to allocate those costs to those, as well as when to recognize those costs. So we're talking about accrued costs versus actually recognized costs as we're recognizing the revenue. And the challenge that other commissions calculation engines have is that they're really only working off billings data and not truly working off revenue recognition data. And what we've seen customers asking us is how to tie their revenue recognition data to the cost recognition data, and in this case, recognition of commission costs, to truly hit the requirements for accounting matching principle, right? When I recognize cost and revenue together. And since RER has such really strong and good accrual engines and calculation of recognition patterns engines, we're leveraging that functionality already to add this layer on top of what SAP has already deployed with RER tool. And that is, I think, that the key here is that we're stretching the tool's functionality beyond just revenue recognition, and in here is we're stretching it into a more sophisticated cost recognition functionalities.
Excellent.
And where particular large contracts see situations that get canceled or short-lived, as we call it, the commission that is attached to those large contracts can similarly be short-lived. So that alignment again can occur with the RER implementation. On the portfolio side, we acknowledge that a level of impairment can be applied to the portfolio commissions so that they get accelerated for their recognition.
Excellent. All right, so we've got these 3 areas we've touched upon: commission, significant financing component, and the standalone selling price. These concepts of revenue recognition, and it all has to come together because ultimately what revenue recognition is all about is reporting on it. So we'd like to take a couple minutes to talk about that side of things and actually sharing that information. And so Vivek, I'm going to ask you to come in. And I apologize, people.
Sure, Dave. Thank you. So good afternoon, everybody. So Frank and Jacek have talked about the revenue accounting part of RAR. I'd like to talk very briefly about the latter part, reporting. RAR, as we know, generates a large volume of data, but this data or any data isn't useful unless you can access it and organize it in a usable way. Like you mentioned earlier, we at Bramasol have been working in RevRec for quite a long time, almost 10 years now. And very early on, we realized that there was a better way to help organizations do their RAR reporting, which is why we developed the Bramasol RAR reporting package. We started off a small set of reports that directly address the disclosure requirements, and grew the offering from there, adding operational reports and tools and utilities to make stuff easier for RevRec users. Can we go to the next slide, please? So very briefly, there are 2 kinds of RAR reporting that we targeted: compliance reports and operational reports. They all work very well and have been well received, but they all share one fundamental characteristic. They report on the lowest level of data, down at the POB level. That's usually great and is actually exactly what you need if you're a member of the revenue team running the numbers to prepare the 10Q for your organization. But if you're someone like a revenue director and want a high-level view of the deferred revenue for the next 3 quarters, the standard disclosure reports can be a bit cumbersome. There's just too much information. Next slide, please. So fortunately, SAP provides a tool. I think you went a little ahead, Dave.
Sorry.
Yeah. So fortunately, SAP provides a tool that many organizations already own that can help with that. That's SAP Analytics Cloud. What we've done is used our expertise with RAR and layered it with what we've learned developing the RAR reporting package to create a new layer of reporting. The primary difference with reporting on SAC versus the standard ABAP reports that we are used to is that these work on aggregated data. The raw data is still there, but for this level of reporting, like we've seen, it can be a distraction. So these SAC dashboards that we have made are cloud-based and integrate with RAR on either S/4HANA or even ECC. The RAR data can be directly extracted, or you can use BW as an intermediary staging area. We built the extractors and the RAR logic that live in the SAC layer, and they make their output available for consumption by any standard or custom visual. Next slide, please. So as with any dashboard, the intent is to provide the important numbers front and center, and then allow the user to look deeper if they need to. Now, some of you may have spotted a flaw with that approach. Different users will look for different things. User one's primary focus might be the deferred revenue, as that's what's most important to him or her. But for another user too, the recognized revenue may be the main focus. And that's why there's no one-size-fits-all revenue dashboard. What we built here is a toolkit that accelerates the development of custom dashboards for an organization's needs. Next slide, please. The key takeaway here is when you have the data extracted and organized in SAC, it can then be consumed by any visual or widget. These can be the out-of-the-box versions that SAP supplies that come with SAC, or even visuals or widgets that you have developed in-house or you even purchase from third parties. Next slide. And that's just the tip of the iceberg. SAC also offers additional tools which can be integrated with these reports. They enrich them. You can blend in non-RAR data to move on to the next level of RevRec reporting to identify trends. You can use natural language queries, predictive analytics to generate forecasts. So those are all tied in with the capabilities of SAC. And next slide. So to wrap up, RevRec reporting is about a lot more than just simply compliance. SAC dashboards offer organizations transformative opportunities by aggregating large quantities of data. In that ocean of information, our dashboards are intended to help companies organize and make sense of their RevRec data so that it can be used effectively. Dave?
Yeah, thank you, Vivek. So a lot of companies use these dashboards, use this information too, right? It brings a lot of power to companies that we've worked with. It's where we started. The first thing we saw is the disclosure reporting needed to improve, and then from that, the operational management reporting needed to be offered, and it needed to be summarized. It needed to be presented flexibly and in ways that are consumable. And there's a lot of positive reaction from a lot of companies on that.
Very true. So the more you use these reports, the more you realize what more you can get out of them.
Excellent, excellent. Well, guys, our panel, thank you very much. A lot of information covered today. John, I might ask you for any closing summarizing comments you have based on what was shared.
Yeah, sure, Dave. Thank you. And what a great webinar. Great insights from the organization and from our team who's been involved in all these projects. I think I would wrap it up by saying, you know, after 10 years of experience, what Bramasol has done and what companies need to think about is RAR is the most powerful revenue accounting engine out there in the world. It's the most flexible, scalable, and automated tool out there. But a lot of companies look for more, whether it's in the aspects of what we showed early on SSP and learning about how do I create a flexible tool that allows me to look at my data the way I want to and take that analysis beyond. Or in the case of carve-ins and carve-outs, what we've seen very interestingly enough is both of those. If we look at the top line of what we saw initially around significant finance component, what we're seeing is a breakout, Dave, in organizations that are exploring things like leasing as a tool or significant finance component. Our ability to ask the questions and help customers really focus on what matters to them in terms of looking at the interest income and looking at the actual amortization, whether it applies to SFC or to leasing, the tools are there to help companies break that out. And Bramasol has a considered approach to all of that. And I'm excited that we were able to share all of that with the teams today. And it's really about an iterative conversational process up front. A lot of this work gets done up front. And I would say to companies, clients out there, if your SI isn't asking you questions about all of these areas, you know, maybe you need to consider people who are deep experts in this space, because every customer we run into has something in one of these flavors. But it was a great webinar, Dave, and thanks for hosting it.
Oh, you're welcome. So we got like a moment left. I know the question button's been flashing. I'm not sure, John and team, if we've seen any questions we could address real quickly here, or if we need to follow up on.
We had a customer asking a few questions about customers moving from ECC to S/4HANA. We are seeing a lot of that taking place, and we are happy to explore with you and talk with customers about what do you need to think about as you move away from SAP's SD RevRec and what are some of the processes, what are some of the activities you've done to get it to work for IFRS 16 or ASC 606. You know, we're going to be doing some webinars and podcasts in the future about that specific topic, but we're seeing it come up more and more, and there are a lot of, as one of our customers who's on here from a large hardware, software, technology organization knows, there's a lot that you need to think about as you move in that direction, and we'd love to share and talk with you more about it. So thank you, team. It's always an honor to be on here with all of you.
Yeah, thank you to everyone who's joined, all customers, SAP folks, some other competitors. We appreciate you joining in. John, Frank, and Jacek, Vivek, thank you for your expertise and your inputs. Appreciate it. And we wish everybody a good rest of your day.
All right. Thank you, Dave.
Thank you.